All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.
Now, I know you went to a jazz concert, right? How was that?
That was great.
Was it? First time down there, right?
Right. Yeah. The Smith Center. It's a lot of fun. It's a nice place. Surprising. It's only 10 years old.
Yeah. They not only do they build it pretty quick, but the demand for it's really strong. They do a lot of shows there. But this is not a jazz weekly sense. So the first thing we wanted to pull up this week was, the real monstrous rally that we've seen in the stock market over the last 2 weeks. So what this chart shows is from the March 14th low, which a lot of people called the bottom in this correction. Now they're saying it may not be the bottom. Maybe it's a bear market bounce. I heard a lot of those same things, in April and even in May of 2020. And only time will tell who's right on those calls, but this is pretty monstrous, right? So what this chart looks at is the Qs on the top, which is the NASDAQ, the S&P, which is in the orange color, and then the Dow Jones, which is the light blue on the bottom. Their rallies over the last 2 weeks. It's been a pretty remarkable rally, right, Carl?
Right. I mean, it's a continuation of the rock and roll pace of the correction this year. And I know some people are saying that this is a bear market bounce, but we really don't think so yet, because even though things have been moving quickly and there are a lot of signs that this business cycle will be short, and as we'll get to talking about, the yield curve inversion stuff starting this week, which is really unique, because normally you've never seen that in the past unless you've had significant rate hikes.
Right.
So it's something that we're watching closely and thinking about, but historically you would still have 1 to 2 years left in the business cycle, even from that point. Yeah, but although it can vary.
Yeah, being up 14% in 2 weeks, or 9%, or even 7% in 2 weeks is a pretty remarkable move. Now, what I didn't do, what I'd be interested to see is, what was the performance in February? Was it down 13 or 14% for the NASDAQ? I'm not sure what the numbers are.
It's probably something like that.
Yeah, well,
because the bottom was really February. Well, on the S&P, the bottom was February 24th, but
right.
And that was the NASDAQ low was in March, but it wasn't much lower than that.
Yeah, pretty remarkable rally, but it was basically after the Fed meeting when they gave clear dictation of what their plans were as far as, being aggressive in fighting this sticky inflation that we've got in the economy. And I think the markets, digested that, accepted that, and pushed forward. And what we've also noticed is kind of the numbing effect of everything that's going on in Russia and Ukraine. I know they came out a little bit earlier today and this week saying that, the Russian forces are a little bit stretched, but it seems that the more and more news that comes out of there, the more numbing the market is to kind of that situation. But a lot of this move was really more of a clear path of what the Fed planned to do this year, which was, hike rates relatively aggressively.
Right.
And
yeah.
That leads into this second chart that we've got, which now this isn't a meme stock, Carl. This isn't GameStop or AMC.
Although it could be. It looks like it could be.
It looks a lot like it, doesn't it? Okay, so from the low of 2021, this chart is up 73%. And like I said, it's not a meme stock. It's not a cryptocurrency or an NFT. This is actually what? What is this, Carl?
It's the 30-year mortgage rate.
Unbelievable.
Yeah. So people were asking us all last year, what's going on with housing? Is this sustainable? And a lot of it was driven by pandemic relocation and lower interest rates. But now that those mortgage rates are up, it looks like the housing market may be cooling.
Yeah, the Wall Street Journal came out with an article this week that ties directly with this jump in rates. You can see that drastic jump in 30-year mortgage rates, which currently, as of today, was at 4.89%. And I know Al bought a house in November, and I think his rate was, the high twos, 275, and now it's just in the last 5 months, it's jumped to 489. And that's because of Fed movements. But what the Wall Street Journal came out and said was basically there was a report that came out about refinancing applications fell to 15%, which is down 60% year over year. And that's not surprising, but that could lead to potential weakness in real estate over the coming months and even the coming year.
Right.
And the reason is because the higher rates are, the more money you either have to put down to qualify for a home or show that you have assets to qualify for a home, or more income that you have to show to be able to qualify for that higher interest expense on a mortgage.
Right. It just makes the housing payments for a mortgage go up more. So probably most people's incomes didn't go up 50 to 70%.
not in a year and a half or a year or so. But yeah, and I think, this kind of transcends into what the main talking point has been so far this year. It's been on the top of everybody's mind, and that is yield curve inversion. Now, I'm not going to go into great detail. I'll let you take the ropes on this, because I was interviewed on Yahoo Finance in 2019 at the last yield curve inversion. And it was only 6 months later, after the last yield curve inversion, that we actually had the recession that was primarily due to the lockdowns of COVID. But first, maybe we talk about maybe flattening, right?
Right. Well, it's a good indicator, and people get complicated and academic about it. And sometimes they look for reasons why this time is different, but it's really very simple. When the yield curve flattens, it just means there's not as much profit or any profit for banks to lend money, because how banks work, they lend long-term and they borrow short-term from depositors and Federal Reserve banks.
Right.
And so loans aren't profitable when the yield curve is flat or inverted. And so there's been a lot of change just in the last few months there. And so what's happened,
you could see this, right? So this green line is basically 3 months ago. These are different treasury yields or years. Maturities, 5, 10, 15, 20, 30 year. And you can see, let's look at the 5 year. 3 months ago it was paying 1.25, let's say. And today, 3 months later, it's at 2.5. That's a significant move.
Yeah, right. Yeah. Even the very short, well, not the very short stuff, but yeah, the treasuries that are out, like even at like 1 and 2 years are starting to go up a lot. So there's a lot of, so what's different about this is that there's a lot of flatness in the yield curve before we've had significant rate hikes. Usually the way this works is there's some steepness in the yield curve, and it kind of persists while the very short Fed funds rate is going up. So
now, do you think a part of that has to do with the markets getting smarter and faster?
It's possible. It's also that there's a lot of we're seeing inflation that we haven't seen before, even though there are a lot of reasons to think that it's not permanent. It's going on for longer than people expected. But yes, definitely, like, people are getting smarter and things are speeding up.
And then explain to everybody what, let me pull up the right chart here, what an actual inversion means, Carl. Tell everybody what that means first and why it's important.
Well, all an inversion means is that a treasury yield of a shorter maturity is higher than a treasury yield of a longer maturity. And this can apply for different places in the yield curve, because normally what you expect is you expect higher yields for longer maturities, because if you lend anyone, or in this case, the government, money, you expect to get paid more for a bond or a loan of a longer period of time, because longer term loans are just more risky. You just have, you have risk that interest rates can change, or, that, are you going to get paid and all of that.
Sure.
So generally speaking, the yield curve should be upward sloping. And what happens as you get later in a business cycle is you start to get, before the whole yield curve inverts, which happens when like the very short rates are above the very long-term rates, you start to get little bouts of inversion in the middle and at the longer end. And so that's what we started to see this week. So on Monday, you saw that the 5-year Treasury yield had a slightly higher yield than the 30-year Treasury, and it lasted a little while. And that's not something that you always see. Like we didn't really see it in 2019, but you saw it in 2006 and in 2000, before you started getting the the broader inversion of the 2-year, 10-year spread, which we have a chart of right here.
Yeah, so this is the difference. This chart shows the difference between what a 2-year Treasury is paying and what a 10-year Treasury is paying, and why it's important and why everybody's talking about it is because historically it's been a fairly good indicator, not on the timing necessarily, but a fairly good indicator that an oncoming recession is closer versus being further away. And what this chart looks at is every time it goes below this zero line, which is down here on the bottom, you can see not too far after, whether that's 6 months over here or 17 months over here or 24 months over here, about that time frame, you typically get these recessions, which are highlighted in those gray lines. So that's why it's been a big talking point. Doesn't necessarily mean it tells you when it's going to happen. It's just an indicator of saying that, hey, it's probably going to happen in closer to the nearer term than years out.
Right. Usually it means it's that there could be a recession in like 1 to 2 years.
Right.
And the timing isn't real well defined, because there's a lot of noise and it takes time for like bank lending to slow down.
Sure.
And I like to say the economy is kind of like a battleship in a bathtub. It's hard to move it around. And the shortest lengths of time that it makes sense to think about these things on are probably a quarter or several quarters.
Yeah, well, I know we've got high inflation. That's going to put more pressure on the consumer. You've got the Fed aggressively raising rates, which is going to put more pressure on banks to tighten up their belts. And now you've got inversions on the yield curve. So, I mean, a lot of things, from our standpoint, and we've been telling clients this, that we believe that this is a lot more compressed business cycle. And, if we had to predict, somewhere within the next 18 to 24 months, and if it's longer than that, that's great. Hopefully that means that equity prices continue higher. But that's really the time frame that we're looking at potentially for the next recession. And why it could be longer, or maybe it's shorter than that, is so LPL actually produced this and posted this earlier this week. And what this looks at is the time of inversion. So these are the dates of the previous inversion going back to 1988. These are the dates of the peak of that market. And these are the average rates of return of the indexes from the date of the inversion to the peak of the market. And this is the time that it took. And the average time is about 17 months. The average rate of return is about 28%. So the tricky part about what we do from a portfolio management standpoint is not wanting to be 100% conservative just because we got an inversion, because there still are some chips left on the table that we could still potentially gather, but more so being a mindful reminder that we need to be cautious when we're making decisions within portfolios moving forward, or more cautious decisions moving forward.
Right. So that's why we still think that things will settle down, and we could even see new highs in the market this year.
Yeah.
But we just have to be, watching everything and watching how far the Fed is going to get with the rate hikes and what the reaction to that is. Because at some point there will be some resistance there.
Right. Well, a 14% move in 2 weeks is pretty big. I think you did point out, though, that on the down days this week, it was on lighter than average volume. And I even looked at today, and it was just a little over half the average in the S&P as far as volume.
Right.
It did sell off towards the end. And that's generally, not a sign that there's a lot of force behind the selling.
Right. Exactly.
Yeah. I mean, I wanted to point out one last thing for Weekly Sense, just because it impacts a lot of clients. So the House just passed the Secure Act 2.0. So the Secure Act, the original version of the Secure Act was passed in, I believe it's 2018 or 2019. And essentially that raised the year for clients that when they had to take required minimum distribution. So it had always been 70 and a half. The Secure Act raised it to age 72. The Secure Act 2.0, which, like I said, just got passed by the House. It still has to go through the Senate, so it can be reworked a little bit. But as it stands now, they're actually raising the required minimum distribution age to age 73. That would start next year if it's passed fully. And then by 2033, it goes all the way up to age 75. So Congress is making some adjustments. It's interesting to me that they are extending the age of distributions, probably looking at the average consumer. We talked about a statistic a few weeks ago that 60% of Americans live paycheck to paycheck. So maybe extending the deferral time before they have to take distributions is something that they've got in mind. And they're also working on some things with regards to 401k plans, catch-up contributions, finally potentially being able to match inside of a Roth 401k. Which they can't do now. So we'll keep you, up to date on any of those, because it does directly affect our clients. But it's just interesting to see that Congress is working on some of these policies that are actually extending the age of distributions from clients from 70 and a half to potentially now 75 or 73 next year, if it does get passed in the way that it's written today.
Right. Well, it makes sense. Life expectancies are going up, and personal retirement accounts are becoming a larger part of how people save for retirement.
Yeah, there's no more lifetime pensions anymore, or very few.
Well, yeah, most of the companies with that stuff have had a bankruptcy.
Right, like General Motors, Ford, GM. So, well, very good. Anything else, Carl?
That's it. We're just watching everything carefully, and we'll see how the rest of this year plays out.
Great. Well, hey, next time we talk, it'll be in April. This first quarter's done. We will be putting out our quarterly commentary within the next few weeks. So keep an eye out on that. And if you guys have any questions, make sure to email us or hit the comment button below. We always love talking about this stuff. Thanks, Carl. Appreciate you.
Stay tuned.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.